In this week's update, how to play the next 2 weeks until the election and why I remain ultra bullish in the longer term. My name's Garry Davis, and as always, this is general advice only, and remember to subscribe and like the video. Just to start with a bit of overall perspective, as I do every week, there's plenty to be jittery about in the US, and maybe things will get volatile for the next 10 to 14 days, who knows. In the run-up to the 2016 election, the S&P lost 10% in the week or week and a half leading into that. Will we see a repeat? I don't know. I don't spend too much time thinking about it because it doesn't really matter. I'm not a really ultra short-term trader, so it really doesn't impact me at all. In fact, in a lot of ways, it presents opportunities because the volatility offers us short-term price opportunities to enter that we may not otherwise get. Secondly, of course, we've still got COVID around and the Northern Hemisphere is going into winter conditions. So it's reasonable to assume that the caseload of COVID infections is probably going to rise, and we don't know how that's going to play out and probably more importantly, how government's going to respond to it. And the third thing, of course, is we're just at the front end of earnings season, and earnings season is always a little bit unpredictable and could add to what is already a pretty volatile mix. But the early signs are that we're seeing an amazing beat rate on both top and bottom lines. Now, I know that the best reports tend to come out early on and the worst reports tend to come out late in the piece, but this really is an amazing reporting season we've had so far, with 80 of the S&P 500 stocks beating estimates and only 4 missing. Now, normally the ratio sits somewhere around about 70% beating versus missing, and it's obviously way higher this time round. But look, the reality is that markets value certainty very highly because it equates to safety, I think, in investors' minds. The more certainty they've got about the growth of future earnings, the safer it makes. And investors are well and truly prepared to pay up for that sort of revenue and earnings certainty. And stocks that can be relied on to grow, and if you go back 10 years or so, then stocks like Amazon were seemingly trading on just ridiculous PE multiples when they were just a couple of $100, and now Amazon is tenfold that in price. And so people were scratching their head and they couldn't work out why stocks like Amazon and Facebook were so highly valued. But history shows that they've grown into those valuations. And so those sort of stocks are always going to have a much higher PE. And if you look in the Australian context, stocks like CSL have always been valued on extremely high PE ratios and still are. And yet we now find that CSL is the biggest stock in the Australian market. It's probably now regarded as quite a conservative stock. And so that high PE multiple has not been a barrier to tremendous performance. So you don't want to shy away from stocks just because they've got very high PE ratios now. And over recent weeks, I've been talking about relative strength and how important that is. And if you can combine those two things, which is relative strength, so trends that are occurring now, with that sort of almost certainty or very high likelihood of revenue growth and profit growth in the future, then it's a very powerful combination. And I just want to show you just one example, and this is by no means a recommendation. In fact, I probably wouldn't be looking to buy this stock at this point in time, but this is a stock called Twilio, and they're involved in cloud communication software. Many viewers of this video may not have heard of Twilio or understand anything about what they do. But if we pan back and look at what the share price has done, so we came out of a base in 2018, so about 2.5 years ago, it was trading under $30, and now we're trading at $300. So it's been a tenfold increase in that period of time. And buying into a stock like Twilio back here in the early 2018s, when it was starting to trend, so it had the really robust outlook, and it was starting to trend. So that combination of those two things, and you can see what the outcome has been over a long period of time. Now, there's two things I want to say about this. First of all, is that this is a stock that still has, despite these gains, still has a tremendous outlook, and I'm highly confident that in the medium to longer term, the stock price is going to be even higher than it is at the moment, and probably significantly higher. Now, I can't speak to what the price might do in the short term. It could come back significantly if there's a disruption around the US election. But in the medium to longer term, I'm pretty comfortable that this has still got a long way to go. So therefore, there are opportunities if you've got the right sort of game plan to make money out of a stock like Twilio. But the second point that I want to make is that there are literally hundreds of Twilios in 2018 out there. And this is something that's getting a lot of focus in both my services, particularly Portfolio Analyst. So they're the two key points. You can still make money from stocks like this. The opportunity is not lost. You just need to be clear about how you're going to do it. And then the second point is that there are many, many other young companies that are like this one was a couple of years ago. It's the most exciting period that I've ever experienced in the market. And it's for two reasons: because of the acceleration, the exponential acceleration of technology, and secondly, the fact that the COVID restrictions have brought forward trends that were always going to unfold, but it's brought them forward now in an absolute rush. If you look at a stock like Zoom, for instance, they were, I just forget the numbers, but their revenues have gone up by more than tenfold just this year. Now that would never have happened without COVID. So that's brought the use of video conferencing basically into the mainstream. All right, enough on that. Turning to American stocks, the S&P ended up losing 0.5% on the week. It gained about that much on Friday night, so not a bad finish to the week. Earnings are coming through at the moment, as I said earlier, we're just well beyond expectations. And as I said last week, I think the election, rather than worrying about who wins, I think it's really just about the composition of the House, and therefore how much stimulus is going to result. Whilst I'm concerned about a Democrat clean sweep and therefore them winding back the corporate tax cuts that Trump brought in, it's also probably pretty factual to say that the Democrats are going to bring a much larger stimulus package than what the Republicans would do. So how that nets out is hard to say. The US dollar slipped again down to 92.77, but interestingly, the 10-year yield is still in uptrend to 0.84%. So, you know, I've spoken about this a couple of weeks ago. This is a really interesting trend that we've got to watch closely, because obviously central banks are doing all they can to keep interest rates at effectively zero or even negative. And if the yields are going up because of market forces, then that's something that's going to put central banks in a difficult position. All right, let's just have a quick look at the S&P index. That's the monthly chart going back to the start of this century, but this is the daily. So you can see we're still just fluctuating up and down. We're only a percentage point or so from the all-time highs that we saw in at the start of September. So we've managed to get through the September-October period, which is generally some of the more volatile times, and this year even more so, without a lot of skin off the bone, if you like. And we're still up pretty close to all-time highs. You can see we're still tracking above the 20-day moving average and the 50, and of course the 200 as well is miles below. So it's still a very positive orientation for the US market. Here's the US dollar. So we had a bit of a blip, which you always tend to get from a period of being oversold, but now we seem to have resumed the downtrend. So that's certainly not going to be a bad thing for the gold price. And there's the Australian dollar, pretty much the reverse of what the US has done. Let's just look at the Australian index while we're here. So not a lot of change. You can see we're just stuck, basically stuck around this 6,200 or just under level. And it's really hard with the composition of the Australian index being so heavily by the banks and the major materials and healthcare stocks that it's really hard to see what would spur the index higher. Anyway, we shall see. So the Aussie dollar 71.2, and our index ended up losing 0.2% on the week, which is neither here nor there. Amongst the growth stocks, which is where most of my activity, or virtually all of my activity is, there was certainly plenty of nervous profit taking last week, and especially on Friday. Now, the volumes were modest, and none of the moves were particularly large, but it just seemed like there was a real desire to take a bit of money off the table. This is where you really need conviction about the stocks that you own, because if you don't have conviction, it's easy to get shaken out of those really valuable long-term positions by periods like we've just had in the last 6-7 weeks. So you've really got to have high conviction about what you're doing. Precious metals, gold up just a touch to 1902, and there's really been no change to the consolidate high theory that I've been talking about, and that is that the excess from the August surge that we saw, July-August surge, which would normally be expected to play out with a correction of perhaps 20%, bring gold back to the 200-day moving average, bring GDX back to the 200-day moving average. That doesn't seem to be happening this time, and it's like the excess is being washed out by time. And look, that's happened on occasions. It's not the usual pattern, but it's certainly pointing to fundamental underlying strength in the gold price. Now, GLD holdings have remained steady, so money, the investment side of things, money is not flowing out of that area, despite the fact that gold is really just in sideways movement. I feel pretty confident that another surge is coming. I'm just not sure when it is, because normally the normal sort of corrections, they get done fairly quickly, and you tend to see a fairly sharply defined bottom and rebound. This time, I suspect we're just going to grind sideways for a while, work off the excess, and then we'll start to move higher on some catalyst or other. Precious metal stocks, as I've said recently, all the indications are that we're going to see an absolute explosion in profit in Q3. There were reasons why Q2 was weaker, but as those earnings reports start to come through, I think it's really going to make the market sit up and take notice. So let's look at the gold price. So this is on the daily, and you can see we've really done very, very little now for several weeks. And viewed on the weekly chart, you can see we're still consolidating around this major breakout. So that major breakout was the peak of 2011, the previous high price in gold, and we've just toing and froing above and below that really critical level. And if we look at GDX, yes, we're in a declining triangle, and yes, that support could break. If there was a sudden surge in the US dollar for whatever reason that caused the gold price to make a sharp move, then we'll probably see GDX break this support and perhaps come down and test the 200-day moving average, which is what we normally see. But in the absence of that, at the moment, it's still looking all pretty calm and orderly. Turning to other commodities, copper has really surged in the last couple of weeks, up to $3.15. At a big picture level, we're now sitting close to resistance, and I'll show you some longer term charts of the copper price. There has been a real surge in China's buying. So the question on a lot of commodity analyst lips is this a sustainable buying spree, or is it just China stockpiling ahead of whatever it is they're stockpiling ahead of? We don't know the answer to that. We'll only know in hindsight. The reason that I talk about copper is that it's such an important indicator of global economic health. And so the question is, are we actually getting a valid signal about global economic health, or are we getting a bit of a red herring at the moment just because of China's got a buying splurge going on? Don't know the answer to that, but certainly the signs for global growth are not poor. I think that's the one thing that we can say. They're neutral to somewhat positive outlook. And of course, longer term, beyond 2022, the outlook for copper and other base metals is really pretty good. Now, and in fact, that may even come a little bit sooner if China is not just stockpiling, because the previous forecasts were that copper would be in a surplus position, so there'd be more produced than what was than demand. That was the previous forecast, but now they're forecasting a deficit very, very quickly. So, you know, that's been an abrupt change just in the last month or so. And again, the importance of this is that there is a very strong positive correlation between the direction of the S&P or stocks in general and the copper price. So if the copper price breaks out, the correlation with the S&P is so strong that you've almost got to expect the S&P to break out to new highs as well. So that's the importance of all this. Now, crude oil fell a bit, fell about $1.50 down to just a tick under $40. So crude oil not really doing anything at the moment. So there's the 1 year copper chart. So you can see the big recovery we've had since the crash, where we got down close to $2, and now we're around the 310, 315 mark. Going back further, so this is the 5 year chart, and you can see we're getting up close to the highs, which were around 325, 330, which occurred in late 2017 and early 2018. So if we can get above those highs, then you know, that is a really, really significant event for copper, and will be a really good positive for stocks in general as well. So bears watching very closely. So wrapping it up, and I talk about this virtually every week, my overwhelming advice is to narrow your focus to the stocks that have a high probability of growth. Don't get caught thinking about the market in general and basing your investment decisions and your timing on the market in general. Let's just go with what's working. Focus on the stocks that have got a high probability of growth. They may or may not be trending at the moment, but if they're also showing relative strength, then that's a bonus, and try and have a blend of those two things. The world is changing so rapidly, and those that can acknowledge the winners in this change are going to do very well, I believe. So you need to develop your own process, because just fronting up to the market and thinking you're going to take a few tips and buy a few stocks that are being recommended and that you're going to make a lot of money is just not going to happen. You need to have a really clear game plan, and there are a number of reasons for that, but the primary reason is that going forward it's going to be volatile, and unless you've got conviction and structure around what you're doing, it's going to be very, very difficult to stay on board. So hence the importance of developing your process. And this is something we spend quite a bit of time on in Portfolio Analyst, for those that haven't tried that. And Portfolio Analyst this week, it's really just a continuation of what we've been doing pretty much all year. And that's just lining up the absolute mountain of possibilities. There really are so many, it's mind-boggling. So that's it for this week. If you want to find out more about the services that I provide, there's information on the website, and there's my email address for anyone that wants to communicate directly with me. So that's it for this week.